Welcome back to EG Financials. Today we're taking a look at Fannie Mae's real estate market forecast for 2024. We'll be looking at volume, so number of sales, and also their price predictions for 2024. And then finally, we'll take a look at some key highlights from the report that they put out this morning. And here we go. Let's get started with total home sales. They're expecting home sales to stay pretty flat, a slight increase from 2023 to 2024. It'll be up to 4.9 million, which would be only a 0.6% increase in total home sales from 2023 to 2024. Next, we have their year-over-year price predictions for the real estate market. They're expecting 2023 to end the year at 3.9% appreciation. And then again, it's going to be pretty flat going into 2024, where it's going to end the year with a decrease of 0.7%. And next, we have their projections for the 30-year fixed rate. Currently, today, as of August 23rd, 2023, mortgage rates are pretty close to 7.5%, and Fannie Mae is expecting the 30-year fixed rate to decrease down to 6.6% by the end of this year, and then a further decrease down to 6.3% in 2024. Next, let's take a look at their commentary from the report they released this morning. I made some key highlights. Recent economic data point to a stronger economy over the second quarter than we previously expected, leading to an upgrade to our near-term real gross domestic product (GDP) growth outlook. Growth has been resilient while inflation has eased significantly. These data suggest the likelihood of a so-called soft landing, in which inflation returns to the Federal Reserve's target without a significant rise in the unemployment rate, has increased. With an ongoing tight supply of existing homes for sale and the recent rise in the 30-year fixed rate mortgage rate to around 7%, we expect home sales in 2023 to remain near the lowest annual level since 2009. In this chart, we can take a look at core inflation and compare it to the different categories within it. So again, core inflation excludes energy prices and food prices because they're typically more volatile. The dark blue line shows core inflation, only excluding energy prices and food prices. Then the light blue line shows core inflation excluding shelter, and then the orange line shows only services excluding energy and shelter. In this chart, we're looking at total employment versus temporary employment, and temporary employment is a great leading indicator for the labor market. If we start to see a dip in temporary employment, we can expect employment to decrease overall. We expect that further Fed fund rate hikes are off the table for now following the latest hike in July, given decelerating inflation measures and the lagged effects of tightening that has already occurred. If a recession is avoided, then ongoing limited supply of homes for sale on the market, combined with continued affordability constraints and the ongoing lock-in effect, whereby existing owners do not want to give up their current low mortgage rates, is expected to lead to a low pace of sales. In the case of a recession scenario, interest rates would likely pull back somewhat, lessening the lock-in effect, thereby potentially boosting the number of homes available for sale. However, in a recession, a weaker labor market, tighter credit, and lower consumer confidence would act as downward pressure on housing. And that's it for today. Tomorrow I'll be consolidating all of these real estate market forecasts from the top institutions, and it'll be neat to compare all of the projections and see overall, are we expecting the market to go up or down, and any other indicators that they might have shared. So make sure you follow.